We are now going to talk about leasehold improvements, which is a fairly new section to the VAT Act. Leasehold improvements, understand first what a leasehold improvement is. So here's A Limited. A Limited has a piece of land and it has a building on it. X Limited then comes to A Limited and say, I want to lease this from you. So A Limited is the lessor and X Limited is the lessee. So X Limited is not the owner, they're just going to lease it. Then they enter into an agreement and they say, as part of this agreement, A Limited says to X Limited, you need to build another building on there as part of your lease agreement. Now this might seem strange to you guys, but this is very, very common in practice. Think about it in reality. X Limited might be a big factory or a big company like Coca-Cola, and they need, this is an office block and they have to build a factory on there, right? So they might want to do it because they want to have the rent the property. Now, what's important for you to understand is that X Limited, the lessee who is building this, can either charge A Limited for this property and say, A Limited says you need to build a factory of 5 million rands and they will pay you the 5 million rands, or A Limited just says you need to build a factory and X Limited doesn't charge them. Now, if X Limited charge them, we'll treat it in one way, and if X Limited doesn't charge them, we'll treat it in a different way. So, basically we've got two situations for leasehold improvements, where the lessee charged the lessor and where the lessee did not charge the lessor. Now, if the lessee charged the lessor, then the normal rules will apply. That means the lessee will incur costs to build the leasehold property improvement. They can claim all of the input VAT. And then when they sell it to the lessor, they will raise output VAT. Right, so normal, sale of an asset. The lessor will then be able to claim the input VAT, but on the invoice that they received. But now, if the lessee did not charge the lessor, things are a little bit different. So how it works, you'll see is, Section 829 tells us that the lessee will be treated as if they made a deemed sale. There's a special value and timing rule, and then there's a special rule, but for the lessor only in terms of Section 18C. So let's talk about it. So first up, if the lessee charged the lessor, so that's this situation here, scenario A, it will just be the normal rules that applies. So here you go, the lessee can claim input tax and they must raise output tax. The lessor can then claim as input tax whatever this output tax was that was raised. Remember our usual examples when I always go and I say here's the seller, and the seller gives something to the buyer. The seller gives an invoice that says X VAT 100 rands, VAT 15 rands, and then it's a total of 115. This buyer can claim input tax. What input tax is it? The amount on the invoice. That's what we're saying over here. So this output tax here that the lessee raises is this output tax, and this input tax that the lessor claims is this input tax on the same amount. Right, so a normal transaction. But what happens if the lessee did not charge the lessor? Okay, so now what you need to see is, first up, we're looking at the lessee here. The lessee is treated as if they sold that leasehold improvement to the lessor. So they didn't, but they treated it as if they did in terms of Section 829. So that means they are treated as if they made a taxable supply. Right, very important here though, over here, is if it was used 100%, not less than that, 100%, not for taxable supplies, like exempt supplies, then this section is ignored, so there's no VAT implications. Okay, so now, per Section 829, the lessee is treated as if they sold it to the lessor. How much are they treated as if they sold it for? Section 912 tells us that they are, Section 1028 tells us that they are treated as if they sold it for 0 rands. Right, so the output tax by the lessee will be 0. Because they are treated as if they sold it, they can still claim any input tax that they incurred in making the asset. Right, and building that leasehold improvement. That's what we say over here. When does it take place? It's deemed to take place at the time when the leasehold improvements are completed. Right, what about the lessor? So the lessor now is the owner of the property. The lessor was not charged in reality, but what happens now? So remember, the lessee is treated as if they sold it to the lessor. So the lessor is first of all treated as if it purchased the leasehold improvement from the lessee in terms of Section 829. But section 829 goes to section 912, section 1028, sorry, which says it's treated as it was sold for null. So the lessor is treated as if they purchased it for null rand, so they can claim input tax of null. But now there's a special rule then. It says, section 18 capital C says, the lessor will charge output tax, or will pay output tax, if they did not use it for taxable supplies. The calculation says it's the value of the leasehold improvement per the contract, or the open market value, if you don't have the value, times 15 over 115%, times the percentage exempt supplies. So, if the lessor is going to use it 80% for taxable supplies and 20% for exempt supplies, and the value of that is a million, you'll say 1 million times 15 over 115 times the percentage that is exempt, 20%. And that is a special rule there. Very new section, guys. Hasn't really been asked yet, but do be aware of it.